Hello everyone and welcome to a new video. This is the first video of a series where I'll explain the most relevant and useful trading indicators that you can use while doing technical analysis. I'll also start another series to give some base knowledge about the practice of trading, but I feel like having some basic knowledge before putting your hands on a chart is the best way to go. If you need some refreshing about how to use TradingView, I also have a playlist with a couple of videos that explains just that. Click the link on the top right corner if you missed it. Now the first indicator that I want to address my attention to are Bollinger Bands, but in the process we'll also see what moving averages are. So first things first, what are Bollinger Bands? Well, from an historic point of view, Bollinger Bands are a trading tool that the homonym John Bollinger came up with after his realization in the 80s that market volatility was dynamic and not static as it was believed at the time. If we dive into some kind of chart view, just like that, we can plot the Bollinger Bands directly on the price action, and they look like this, three lines that kind of follow the movement of the price. The indicator is composed by three main elements: a lower band, an upper band, and a middle line that represents another indicator, which is called the moving average or simple moving average. Now we know what Bollinger Bands look on a chart, but what are they really? Well, Bollinger Bands are a mathematical function, which in this case I call b of x, that is composed by two things. Let's analyze them in order. The first thing we have is a simple moving average. And I know it sounds complicated, but it's not. A moving average is just an average of some value that moves with the price. In fact, moving average is just the average of the current price with the x previous prices. If we do the calculation for every bar on a trading chart and then connect the points, we get a nice line. That is our moving average. Now, in a more friendly way, SMA or just MA is just a series of prices, and those prices are the X bars before the line is just under or above, and then we average them, and that's it. So if we could take like a virtual magnifying lens on a single point of a moving average line, that price would just represent the average of the X previous bar, for example in this case 10. The source item in the square here means that the prices we are averaging are the close prices for each of these 10 bars. But we could choose to average the open prices or, for example, the typical prices, and it would still work. Now, SMA are quite boring in and of themselves, but paired with something else, they become useful. And in fact, we can now see what else composes the Bollinger Bands indicator, or in other words, the upper and lower bands. Those, from a mathematical point of view, are just standard deviation, one positive and one negative, from the central SMA. Now, if you don't know what a standard deviation is, do not worry. I'll try to explain it the best I can, but it is not necessary to fully comprehend Bollinger Bands. Here is a brief explanation anyway. A standard deviation is just a measure of how spread out numbers are from an average in a given dataset. So if we take, for example, those two datasets of number, it is clear that the variance of the first from its average, which is 50, is much higher than the one of the second set. And that is exactly what standard deviation tells you. And in fact, the formula tells you just that. It is kind of intuitive at the end of the day. Now, it is not important to understand this graph, but only to know that Bollinger Bands are usually at two standard deviations apart from the SMA. Or in other words, at the border of the area where 95% of the prices of the last n days are. The more spread out the last n prices, the higher the standard deviation, the more spread apart the bands. So to summarize, we have an SMA that smooths the price in a given period of time, and two standard deviations that represent how spread out the prices are in this period of time. Now, how to use Bollinger Bands and what strategies can you apply? Well, to dive into that, we first have to distinguish two main situations, which are kind of phases that the indicator goes through again and again and again. A phase of constriction, where the price gets squeezed between the bands that come together, and a phase of expansion, where the opposite is true. Note that it is not important that both bands diverge in different directions to identify an expansion phase. Now, what is the point of Bollinger Bands in the first place? Well, the first reason for their creation is to identify changes in the market volatility and graphically show it on the chart. What about market volatility then? In this scheme, if we assume those dots represent prices on a chart, we can see that the more spread out the prices, the higher the standard deviation, and vice versa. And that simply means that the higher the standard deviation, the higher the volatility, as you would have expected. And in fact, the wider the bands, the higher the market volatility. The closer the bands, the lower the volatility. Here we can see a couple of examples of what we just said. Now, the second main purpose of Bollinger Bands is to identify oversold and overbought thresholds. Those are nothing more than imaginary lines where the price tends to bounce off, caused by resistance and support level. If we take a look at this chart, in fact, this is a nice representation of how the price tends to stay inside the boundaries of his Bollinger Bands and how touching one of them results in a bound. The third reason that can push you into using Bollinger Bands is to identify patterns that may stochastically predict the short-term direction of the price. In particular, we can identify two signals in relation to the situation we are presented with. In the first case, when the price touches the upper band, we can expect a bullish trend, and vice versa. When the price touches the lower band, a bearish trend isn't uncommon. That comes from the fact that after a period of constriction, the bands always tend to expand again, as a result of an increase in volatility. The real signal, however, is represented by the behavior of the opposite band that the price touches. If this one tends to stay flat for a while before following the next one, or if both diverge in opposite direction. That is why it is very important to look at both bands while analyzing a trend using this indicator. The move usually lasts no more than 6 candles, and remind that the change in price is relative to the time frame we are using. 5 or 6 candles in a 1-day time frame are very different from the same number in a 1-minute time frame. The next useful thing in interpreting Bollinger Bands is variances. The first one I call typical variance, or after constriction the upper band starts to expand as the price touches it, and the lower one remains steady and then comes up with the price. This variance can predict a bullish move and may represent an entry signal for a long position, but nothing is really guaranteed. The same is true for a bullish signal. The second variance is the expansion variance. In this case, the opposite bands diverge in the opposite direction before starting to follow the price trend again. In this case, the price move could be stronger, steeper, and the probability is much higher. Finally, I can give you some personal advice of how I personally use this indicator. The first and main thing is never take anything for granted. Don't use Bollinger Band as the single source of information while analyzing a chart, and always look at both bands and another indicator. I usually use trailing stop loss set as a first reference on the SMA price if this is confirmed by other indicators. And that's the end. Hope it was useful and see you next time.